Now, for the Chapter 11 notes, we're going to be going over private colleges and universities. So Chapters 10 and 11 really should be part of the same chapter because Chapter 10 talks about private not-for-profit organizations and Chapter 11 talks about private colleges and universities. And the journal entries and the accounting are essentially the exact same. There's a couple of differences, but in terms of financial reporting, you're going to see the same thing, and most of the rules are going to be the same. So in this chapter, Chapter 11, I have two versions of the notes. So this is the version that's already filled in. So I'm going to show this in the lecture video, and we're going to go over a very important problem in this chapter. So the first thing we'll do is just review what we talked about before. So we know that GASB 35 is going to be prescribing the accounting treatment for public colleges and universities. So remember, for public colleges and universities, you can report as a single government, multiple government, government and business, business type, or fiduciary. That was in the notes. And then you have FASB 116 and 117. This is the basis for the accounting that's going to be done for private colleges and universities and private not-for-profits. So remember, again, Chapter 11 is for private colleges and universities. Now, remember, if you're a private college and university or a private not-for-profit, you have four financial statements. Statement of financial position, which is like a balance sheet. Statement of activities, which is like an income statement. Cash flow statement. And statement of functional expense. It's recommended, it's not necessary unless you're a voluntary health and welfare organization. Now remember that when you have statement of financial position, your net assets are going to be in one of three categories: unrestricted, temporarily restricted, or permanently restricted. When you have statement of activities, when you have revenues, remember, revenues can be either unrestricted, temporarily restricted, or permanently restricted. Okay, so remember, unrestricted means that there is no time or use restriction. It means you can use the money for whatever you want. Whenever you have an expense, it comes out of the unrestricted category. Temporarily restricted is when you have a time or use restriction. Right? So an example of a time restriction would be, don't spend the money until next year. So you can't spend the money now, you can only spend it in the next year. That's a time restriction. Or if the money must be spent for business school scholarships, that's a use restriction. Permanently restricted means the money can never be spent. And for permanently restricted, we're talking about regular endowments. An endowment, of course, is when a donor gives you money and they say, don't spend the principal, but you can invest the money and you can spend the earnings. Remember, whenever you have expenses, expenses always come out of the unrestricted category. Okay, so super important. All expenses must come out of the unrestricted net asset category. If an organization wants to spend or expense temporarily or permanently restricted net assets, it has to move the money into the unrestricted category before it spends it. So we'll see an example of how that works in just a moment. Okay, in here we have different types of split interest agreements. So you can look at these yourself. These are not super important, but I put them in the notes just for you to look at. Let's take a look at in-class problem number 1. Okay, so in-class problem number 1, the answer is already here, but I want to explain how to get the answer. And Here it says in the problem, at the end of 2004, the Learning Tree, a not-for-profit organization, received a $5 million contribution consisting entirely of investment securities. The contribution is required to be used to establish a permanent endowment. Okay, so this $5 million is going to be permanently restricted. But it says the income from which must be used exclusively to provide free chapter books to elementary school children. Okay, so this $5 million can never be spent, so that's a permanent endowment. But the income has a use restriction. It has to be used for chapter books for elementary school children. So I know that the $5 million is going to be permanently restricted, and whatever income you get off the $5 million, if it has to be used for a specific purpose, we call that temporarily restricted. It says the endowment specifies that both realized and unrealized gains may be used for this purpose, in addition to investment income. The Learning Tree follows FASB, not-for-profit accounting. Okay, so let's take a look here. What happened in 2005? It said in 2005, the Learning Tree had $600,000 in unrestricted net assets. Okay, so let's take a look down here. 2005, you had $600,000 in unrestricted net assets. That's what it says in the problem. And you have $5 million in a permanent endowment. Now it says during 2005, the endowment earns $100,000 in dividends and interest. Remember, this money can only be spent for chapter books. The Learning Tree spends the entire amount on books and distribution costs. Okay, so that's the first thing up here. And then it says at the year end, the value of the endowment portfolio is now $5.5 million. Okay, so two things are going on here. So the two things are, number one, you have $100,000 in interest and dividends. So notice, very important, see the $100,000 goes into temporarily restricted right here. Then it says you spend the money. So if you spend $100,000 in the temporarily restricted category, you have to, it says negative $10,000. You have to move the money out. It goes into unrestricted right here, and then it gets spent down here. And then it says the portfolio goes up to $5.5 million. So $5.5 million. So it went up $500,000. So that's temporarily restricted. Okay, so at the end of the year, you have $600,000 in unrestricted, $500,000 in temporarily restricted, and then this is the permanent endowment part. Okay, in 2006, it says the endowment earns $100,000 in dividends and interest. The entire amount is spent on books. And the value of everything dropped by $1 million, and now it's $4.5 million. Okay, so that's going to be here. Okay, so we have dividends and interest of $100,000 right here. Dividends and interest of $100,000. Now the reason why it's put into temporarily restricted is because it must be used for chapter books. So when we go ahead and use this money for chapter books, the money's going to move out of temporarily restricted. It's going to go into unrestricted, and then the money gets spent. And then it says that the portfolio has declined in value by $500,000. So we have $500,000 in gain from before, so we subtract $500,000. But that's not enough because the portfolio lost $1 million in value. So we subtract $500,000 from here because there's nowhere else to take the money. Okay, so when the portfolio drops in value, we take $500,000 from the previous gain, and then we have no choice but to take the remaining amount from the principal itself. So then at the end of 2005 and the beginning of 2006, this is the final ending balances at the end of 2005. It says during 2007, the endowment earns $100,000 in interest and dividends, and the entire amount is spent on books, and the portfolio has gone up in value by 0.4 million to 4.9 million. Okay, so here you can see again, in the last year, we get $100,000 in dividends. It's temporarily restricted because it must be spent on books. When we go ahead and spend the money on books, the money comes out of temporarily restricted, goes into unrestricted, then it's subtracted because it goes out, it's being spent. And then the portfolio has increased by 400,000. So we put 400,000 under the permanently restricted category so that it becomes 4.9 million. This number has to get back up to 5 million. After that, if we have any other gains, it can go in the temporarily restricted category because the gains above 5 million can be spent. Okay, so that's an explanation of the most important concepts in this chapter. I'm going to provide some more solutions to the other problem that is in the notes and also some more resources for you. If you have any other questions for me, feel free to reach out and let me know.